Accounting is full of little kind of rules, and we'll just say that the accounting gods are the ones who make these rules up. So the accounting gods have pretty much said that you have to mark down assets. Well, what the hell does that mean? So marking down an asset means that if you've used it and it has lost value through that use, or just lost value anyway, you have to tell your people outside the company the asset's not worth as much as it used to be. Depreciation, as we've talked about, is one way to do this. There's other ways to do this as well, but let's kind of think more about this idea. If you get to mark down something, does that mean you need to raise the price if it goes up in value? So for example, let's say that laptop I bought becomes a collector's item because, I don't know, it's the last laptop that Steve Jobs ever made. So because of that, let's say that I bought it for $600, it's now worth $1,000. Do I get to say, hey, my laptop account goes from $600 to $1,000? Accounting gods say no. That's not how it works. You see, you're not actually able to raise the value of assets unless you actually build that asset and make it yourself, according to the accounting rules. It can only go down in value. So, what does that mean? It means that even if that laptop that I just bought went in value to normal people from $600 to $1,000, I still say, hey, it's only worth $600. And actually, since I used it this last year, we're gonna subtract that $200 that I expected to use it for in depreciation. And now on my books, or on my assets, it's only worth $400. So, very complicated idea here, so let's recap it a little bit here. The accounting gods say that assets can only go down in value. They cannot go up. You will never see an asset rise in value on the balance sheet. However, because an asset has to go down in value through depreciation, especially long-term assets, every year you're going to see accumulated depreciation grow as long as these people have assets that are growing as well. That laptop in year 4 is going to be worth $0 because I've completely used all of its value up according to depreciation. So let's say on year 4, how much is that laptop going to be worth? Well, it was worth $600 when I bought it. I've subtracted $200 every year. It can't be worth negative $200, can it? Luckily, once again, the accounting gods have a rule for that. It can only be worth 0 at the very minimum. And so, if you use your laptop that you expected to use for 3 years, for 4 or 5 years, your laptop's actually still worth $0 in year 4 and year 5. That's because your accumulated depreciation can never be higher than what the total value of the laptop was when you first bought it. Let's do a quick recap, make it all very easy. You buy a laptop at $600 in year 1. In year 2, it's technically worth $1,000, but you can't tell anybody that because that's just how the accounting works. And you've used it for 1 year, so now you have accumulated depreciation of $200 and your laptop is really only worth $400 according to your assets. In year 4, your laptop, according to your books, is worth $0, but maybe you're able to still sell it for something. If you do end up selling it, you can have a little bit of profit from that, and we'll go into that later on. But for right now, all you have to remember is that accumulated depreciation can never be more than what you originally paid for the product, but you can never mark that product up as higher as a long-term asset.